Global, that's all we've heard about from a lot of our strategists for the last year and a half. Was that, could they have just been more America-centric, investing in the United States? I mean, it's easier for most people to do it that way. And was that the wrong idea to just, you've got to go global and you could have just stayed here?
You know, Joe, I don't think it was the wrong idea necessarily, but I think what has happened is we've had revisions on economic growth so far this year, and you really have the U.S. accelerating, where, you know, we think we're going to have a print of 4% growth in the second quarter, and frankly, Europe has been decelerating. So I think how we've expressed it in portfolios is we have moved a little bit closer to home, kind of barbelling, more tech, more financials with some utilities as well, just in case. I think there still are opportunities overseas, but you're right, not quite as much as in the beginning of the year. Though I think if one wants to be contrarian, say in a place like Europe, I think you go with the more global European firms who are selling in places like the United States and Asia, which are still growing strongly. But I think that's right, at least so far.
Yeah, I can give you I mean, it's like, they've been drilled into me so much. You know, Europe is a little behind us in the cycle. They still got QE. The valuation, stock market hasn't moved as much there. The synchronous global growth is just starting there. It's early. I mean, there were all these reasons that every person that came on here talked about. And it was staring them in the face. Tax reform, deregulation, all these tailwinds in the United States, and they're still. I mean, I understand diversification, and you want some non-synchronized investments and stuff, but, you know, here we are. They're dead wrong. Not dead wrong, but, you know, you could have been so simple, just buy some domestic ETFs or something.
Yeah, and I think if you look even at kind of forward-looking indicators, we still see much more tailwinds for the U.S. I was a bank analyst at Moody's for 10 years, and one of the things that I like to look a lot at is where C&I loans are going, commercial and industrial loans are going in the U.S. banking system. And because of that deregulation and, you know, maybe in a better term, the partial deconstruction of this administrative state that we had, what you're getting is a massive increase in C&I loans since the beginning of the year. And that's just starting to happen, and that's going to continue to pay dividends going forward.
Debbie, you're in the middle of, you know, you're in Pittsburgh. I mean, I trust you. You know, you're not in this vortex that we're in back here. What are you seeing in terms of what people should do? If there was one thing you worried about, it's the nascent inflationary upturn that we're seeing. Is that the worst thing to worry about now?
I definitely think inflation is something we have to keep our eye on. Certainly, the Fed has been good at moving rates in a normalized fashion over the course of the last 2.5 years. We think that will continue. But inflation is definitely something that is slightly above target range, which, you know, the FOMC has told us is okay at this point. So
you're not saying go to cash. You're just saying you have one foot out the door, or do you just structure the portfolio to anticipate some higher interest rates and higher inflation?
I think you structure the portfolio to anticipate higher interest rates and higher inflation. And luckily, at this point, cash is an asset class that is earning something, 2% or so. And as such, people are easily able to go to cash without having too much of an impact on their portfolio. In fact, you know, if you looked at the first quarter, cash was the only asset class that actually had a positive return.
Yeah. So I mean, you have not change your asset allocation? I mean, have you raised more cash? Is that what you're telling us to do, sort of under your breath, or stay fully invested?
We're staying fully invested at this point. However, several, you know, large clients that we have definitely changed some of their thinking going forward and have put more into the cash and liquidity markets just to sort of keep a little bit of powder dry. So if there is a market correction, they're able to enter into it without, you know, any kind of trepidation or concern, and they have plenty of cash to do so.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.